Hi everybody, it's Greg Kojak. It's St. Patrick's Day, so it's Tuesday, March 17th, 2020. A lot of things still evolving around COVID-19 and the markets, so just want to give probably another 6-7 minutes of recap. I'm wearing my green sweater. It's literally the only day of the year I could probably wear this thing and pull it off, so COVID-19 can't take that away from me. So happy St. Patrick's Day. A couple of things to discuss. The very first thing I want to go, and I know that I cover a lot of charts, but I'm going to take it in a different direction this time, is kind of the emotional tie that we have to money and markets and the way things move. So the first thing I want to do is talk about your view on money and assets on the longer term. Every single conversation I've ever started with a client when it involves investing money is making sure you have at least a 3-year time horizon to invest money. If for whatever reason you think I can profit short term and I'm just going to quickly trade something and make it go up, sell it. If you have a need for a furnace, a roof, a new car that you want to pay with cash, if there's any of these big ticket items, I will always tell you never to invest money, because there could be a very real chance in 2 or 3 years later that the amount of money that you put in is lower than when it started out. Those are markets, and those are kind of the trends that evolve over time. So keep that in mind. Even though we have a reversal, if your accounts are going down, keep in mind that we are looking ahead. That in where you will be, where the economy will be, where your investments will be a year from now, 2 years from now, 3 years from now. So that's point one. The second point, as many of you recall my conversations again about investing, do you have your emergency cash reserve built up? If not, that's the number one place where I will always tell you to stock up. If you're a single person, I usually recommend 6 months, cash, cash, cash. Money market, CD, savings account, earning nothing, unfortunately. But if the economy does take a turn right now, that's where I want you to go. So that way, if you're in a commission-based business or you're a freelancer looking for, and you're getting paid 1099, you're not having to dip into these things as they go down. So if you're married and or two spouses are working, 3 months or 4 months might be a little bit more appropriate. But again, first and foremost, make sure the cash account is there, because there's a good chance you might need it, and always have it on hand. Next point is some of the good news on the monetary policy that's being discussed right now on Capitol Hill. They're talking about putting money back into the economy, specifically around restaurants and airlines, where they're getting affected directly, and they're talking about different strategies for that, essentially putting money into people's pockets so they can keep paying bills. Some of the other things that I'm hearing is a deferral on IRS payments, penalty-free, interest rate-free, so it gives people another opportunity to come up with the money and pay it when they can. There's also lenders out there that I'm hearing are proposing to put up a 0% interest to small businesses for between 30 and 90 days, just to help, again, with payroll issues, to have people on staff, making sure that everybody can continue on and work. In terms of moves, what we're doing with our client accounts, I'm really not a big fan of making moves in these volatile times. If you remember back to when I saw valuations a little high for segments of the market on the growth side, this is going back probably about a year ago. We made some moves then. Going back to late fall and the end of the year, I saw some things I didn't like and didn't trust with high yield specifically and floating rate. So we cut those positions down by at least 50%. So again, these are fixed income or the bond markets. And we moved into a little bit more of a stable position and more conservative in terms of bonds. So when we talk about the administration and what they're looking at, they are firmly behind keeping markets open. But if possible, if needed, they might cut down the amount of time, the hours that the markets are open. But that's good, because they want individuals to have access to their assets and create liquidity if they need it. So those are kind of the big points to recall. Again, I don't want to go into too much detail, but now we're getting into a little bit more of the psyche of maintaining yourself, your how you view your accounts, and know that this is a long-term thing. That don't get scared, but obviously anxiety is running high. Believe me, I feel it too. I see it tick by tick, hour by hour, minute by minute. So I'm not immune to it as well. If you wanted to have a discussion before looking at your statement or before you log in, I'm up for that. Please call me, because a lot of people have the same issue where they just look at their account or they log in and they see this number going down. It's one number, it's one snapshot, one moment in time with no context. It definitely will help you to have a discussion and bring some explanation of the situation, like we're seeing the coronavirus spreading, because there's a lot of unknowns. There's unknown on the health side, the economic side, and that's what's driving all this turmoil in the economy and the markets. So please call me with any questions. Again, this too shall pass. It always does. Obviously, it's different than it's been before, but believe in what we're doing, the steps that we're taking, and I think they're approaching the healthcare side of it with the utmost intensity, where we're now talking about locking down the United States, where it's you stay at home within your own shelter, so that way we don't get into a pattern like we saw with Italy. So I hope that helps. Please call me or email with any questions, and I'll talk to you soon.